In the past trading session, we saw some really interesting movements inside the charts. What could be driving this? And what does it mean for your investments and trades? In this video, we're going to dive a little deeper into the financial plumbing of the system and look into economic health as well. We're going to check out the US banks and most importantly, look through the Tier 1 charts, the charts that move markets globally. Stay tuned, it's going to be fantastic. Hi everyone, I'm Ken from Crypto Trading KS and the inventor of the CTKS method. If you're new, a very warm welcome and welcome back KS family. If you would like to know where smart money is buying and selling, please subscribe. Let's run the numbers. All professional disciplines have rules, and one of the most important rules you can ever learn about financial markets is Rule 446. All markets are intercorrelated and interdependent. When you see a chart like this, or even this, and not to mention this one, or this one, they are all intercorrelated and interdependent. It takes many years, many decades inside financial markets to understand this fact. My goal is to speed up your knowledge and to help you to become more of a financial and emotional blessing to yourself and those you love. The only way you can do that is through knowledge and active learning. We saw some instability inside financial markets in the past 24 hours. We've seen large banks and small banks hemorrhaging deposits. Depositors are taking their money out of financial institutions. This is happening on both the large bank and small banking fronts. You can see the deposits coming out of the financial system are extreme. Simultaneously, the US Treasury cash balance is just falling off a cliff. When it did so last time, what we saw was an increase in the 10-year yield and also the DXY, the US dollar currency index, or the DXY. You might be saying, well, who cares what happens to the DXY and the US dollar currency index and the 10-year yield? It's just unimportant. Well, it's very important, and I'll prove that out to you today. If you do not understand Tier 1 charts, you're going to hemorrhage money inside financial markets. In the last trading session, we saw the US 10-year yield just spike up. The CTKS method gives you X-ray vision as to where smart money is buying and selling. When smart money sells, it suppresses price. When it buys, it pushes it up. And when we throw on the indicator, we can see that the US 10-year yield had enormous resistance up from this 3786 mark up to 3805. And that effectively stopped the US 10-year yield from rising further. If you don't know the CTKS method, you cannot see where smart money is buying and selling. It's also very important to understand safety nets and ceilings inside financial markets. When we look at the DXY, we saw the US 10-year yield spike up and the DXY spike up as well. If you don't have that X-ray vision that the CTKS method gives you, it's very difficult to know why it bounced. Turning on the indicator, which is part of the monthly subscription service, you get the X-ray vision. You can see that DXY was getting into very solid smart money support. It came down and did that technical bounce, as we would expect it to do so. This is why knowing where smart money is buying and selling is incredibly important. Without this indicator, you might have thought when you were up here seeing the DXY just sell down and down and down that it wouldn't bounce, but we know there was so much rock solid support underneath. That's exactly why it hit these safety nets and bounced up. They're effectively safety nets with a trampoline built into them on both the floor and the ceiling. What happens when the DXY and yield spike up? Gold is hit, and it's hit hard. Turning on the indicator from the CTKS Method service, we can understand that we actually pass through a very important structural support level. If we go through a level, we're headed towards the next one. If we have a confluence of levels, as we do around this 1938 mark, it will slow down and potentially reverse price. And we know the US 10-year yield is coming up to some very, very stiff resistance. The CTKS Method service deals with smart money buy and sell levels, but the CTKS Masterclass deals with the knowledge. They're two very, very different things. One thing that we know, the NFCI, Financial Conditions Risk Index, we can see that's been coming down recently. And this is good news, especially for the banking system. But we know the banking system is hemorrhaging money. Deposits are leaving the system. You get this live chart in LV30, which is the living video section of the masterclass. Congratulations, Built to Spill, on being awarded the Meditative Mind CTKS Partial Master Scholarship Award. Well done, my friend, you deserve it. And competition was very, very stiff for that partial masterclass scholarship. Crypto is an incredibly risk-sensitive asset. That's why we need to monitor all financial markets in order to be beneficial inside the crypto market. And a lot of people aren't in crypto, but they love the masterclass, which is a premium Rolls-Royce level masterclass on CTA using the CTKS method, a method of technical analysis invented specifically for crypto that accounts for exponential implosions and explosions in price and updates 270 years of normal technical analysis and can be applied and is applied each and every day to the stock market, forex, commodities, and every other price chart. I'd like to announce that the Ken Stanfield CTKS Partial Masterclass Scholarship is open now. If you show positive excellence, dedication, and commitment, which is absolutely required to get through the masterclass, then you can become eligible for this Partial Masterclass Scholarship Award. We can see after the banking meltdown, we've had quite a good recovery in the banking system. We also know that those deposits are leaving the system. The way the banks make their money is by loaning out deposits through the credit creation multiplier. When money leaves the system, that's a big problem because it reduces that multiplication that the banks can do. That feeds in to GDP. There is some good news out there. The World Bank sees sluggish growth lasting into 2024. The good news is that there is still growth. And some of these projections have been revised upwards. When it comes to stacking probabilities, understanding that copper is an important thing to look at, that red line. You can see copper following the economic cycle. This is the S&P 500. We've seen that copper has diverged recently from the S&P 500's upward path. Copper does this from time to time. It's something that we must keep our eye on. Copper is covered as a Tier 2 chart inside the service. Profits and success come from being synchronized in with financial markets. If we look at the VIX, which is the fear gauge of the main markets, we can see that it's starting to base out. The VIX is a very, very important thing to be aware of. But turning on our X-ray vision inside financial markets, we can see that the VIX is very well supported around this 1384 level. It's currently 1393. What does this mean? It is very, very likely that the VIX will jump up. The DXY is often regarded as a flight to safety, and when we throw on the indicator, we can see that that smart money trampoline of buy orders sent the DXY higher. It's also likely that we're going to get continued pressure on the US 10-year and the DXY, all the yields in fact, because the US Treasury cash balance is so low. To get synchronized in with financial markets, you have to stack probabilities. One way to do so is to look at junk bonds. We saw that as the DXY and yield spiked up, junk bonds spiked down. Why is this the case? It's because junk bonds measure risk-on activity, and when we throw on our X-ray vision, we can see that there was a key level on junk bonds around that 91.33 mark. We passed through that. We're on the opposite side of where we need to be at that 91.08, underneath that smart money resistance level, that sell level. Don't forget that these levels are often magnetized, and if we're not going up, we're definitely going down. One thing to always remember, price moves from SL to SL. What is an SL? It's a Stanfield level. What you can see here, these lines drawn out by the CTKS method, are Stanfield levels or SLs. Many people trade the NASDAQ or the major indices or components of those indices, but they don't bother to look at the other charts. You can see just how large a mistake that is. When we look at the NASDAQ, as yields and the DXY spiked up, what happened to the NASDAQ? It went the way of junk bonds. But how significant is this move? That's the critical question. To answer that question, you need to turn on your X-ray vision through the indicator that is provided free of charge with your monthly subscription into the service. We can see that the NASDAQ came down through this 13,258 mark and also through the 13,206. This is very, very rock solid support. The fact that it punched through that is not good for the NASDAQ. Always remember, price is always moving in a wave. It can go down but up in the same amount of time. So what this actually means is that as the NASDAQ has come down, it's not retested. We could see a retest and a resumption down. Don't just think it's a collapse. That's the wrong way to think. You must always think price is always moving in a wave. The majority of people in the crypto industry wouldn't even dream of looking at the main markets. That is a huge mistake. We can see as the DXY and yield spiked up, that Bitcoin, the leading indicator of crypto health, spiked down. And what is it doing underneath its market structure? To get our X-ray vision on, we need to know where the SLs are. We can see that there's negative momentum. We've not been able to hold this smart money buy area at 27,016, which means we're moving down to the next one at 25,927. Remember, price is always ping-ponging between these different SLs. If it can't get strong enough to go up to the next one, it's going down to the next one. And inside the service, you see the full month of SLs. You'll know what's going on. And I'm doing videos to discuss all of the Tier 1, Tier 2, and Tier 3 charts for the month. When the service started, I only did videos on Tier 1. Now I'm doing videos on all of them. Because Bitcoin is such a risk-on, risk-off indicator, we can use that to gain forward sentiment ideas on the S&P 500 as well. When we saw the spike in yields in the DXY, what naturally followed as junk bonds came down, sentiment turned negative inside the market. If you're looking at price like this, you simply don't know where the X-ray vision is. You don't know where the strong smart money support is. And if we look at the S&P 500, currently 42.67, it's just literally below that 42.69 smart money safety net. And you can see how it's a safety net. What we do with the CTKS method, we trade the right-hand side of the chart, not the left-hand side. We're not interested in the left-hand side. We're interested in the safety nets and ceilings on the right-hand side of the chart. This is a very cursory overview, but you can see that Tier 1 charts are incredibly important. Tier 2 charts are very important as well. If you would like to become a member of the CTKS Method service, it's currently available for a mere $39 per month. This foundation membership will not last. If you would like to get X-ray vision and all of the indicators that are offered as part of the service, make sure you don't miss out on this incredibly special offer. If you're interested in doing the CTKS Masterclass, please reach out to a CTKS ambassador. You'll find them under the Ambassadors tab at cryptotechnicalanalysis.org, and there are so many wonderful people here that you can reach out to. Also, if you go across to the testimonials section, you'll see quite a large number of people have given testimonials on the CTKS Masterclass. You might like to read through those too. Often, looking at financial markets is very, very confusing. As price is always moving in a wave, it confuses many, many people. Also, the financial system is inherently complex, with not just the markets but the charts also being intercorrelated and interdependent on each other. To be successful inside financial markets, you must understand how markets actually work. The markets pull the money together and reallocate that back in terms of profits to those who are synchronized. If you are not synchronized, you'll make losses. If you're synchronized, you'll avoid losses and/or make profits. Always remember, you control the trade or investment, but it's the market that controls the return. Doing your daily three-dimensional risk management, understanding what you will do if the market goes down, goes neutral, or goes up. I'm assuming you're buying long at spot. Always do the preferred option last. Consider the two negative options first. Why is this? Because you prepare yourself, and you must be prepared. The CTKS method upgrades 270 years of technical analysis with all new theories, concepts, and approaches, and it's only taught inside the masterclass and ctksmethod.org. I've been trading and investing for nearly 4 decades, and one of the things that you must always look at is the market pulse. You have to understand the structure and deal with the reality that is price. Don't worry about overlaying what you think it should be, just look at what it actually is. Always have your three-dimensional risk management playing out at all times. It's very important to structure your knowledge. You must know the foundations. You must know how to interpret charts, how to find opportunities, how to master emotional control before you buy or sell. Most people start in reverse. They just go and buy and sell. They don't think about the emotional control that's required. They don't know how to find the focus, so they just pick anything. They ignore interdependencies and they do not have the foundations. That's exactly the wrong way to go. To master emotional control is very, very important. We must use courage instead of fear. All learning takes place in financial markets through losses, not profits through losses. This is the reason why kindness is so critically important. If you are not kind to yourself, you cannot learn. If you cannot learn, the markets will penalize you mercilessly. It's utterly important to respect the financial markets. If you make a loss, don't take it personally. Forgive yourself. This is very important. All lessons are taught by losses, or you could call them lossons. That's why it's incredibly important when you start to have inner peace and outer peace. If you're unraveled from an inner or outer dimension, what you will find is that the market will penalize you for that. More importantly, if you don't maintain self-mastery, your wealth, whatever you earn, will disappear. I'd love to know in the comments, what has been your experience with Positive Excellence? Have you found it helpful? If you're just getting into financial markets, please take this part of the creed. I start small and scale with Borsog. Borsog, Rule 621, buy on red, sell on green. Buying on red is the opposite thing that anybody but a professional would do. Professionals excel in the buying on red. As everybody is running away, professionals are running in. That's why you must start small. Just use coffee money trades to buy on red. Get yourself used to the concept. Don't go all in and more at one particular price level. That is crazy. Inside financial markets, you will get beaten about by doing that. Please don't do that. Graduate into your trade or investment buy-in levels. Every time that you get hit by the market, that will be a life pullback that will hit you in the pocket. Just be aware that is going to happen. The only people who say 0% risk are scammers. It's absolute rubbish. If you consider that all lessons are taught through losses inside financial markets, if somebody's telling you that you don't have to make losses, that person is clearly insane. The key is to keep the losses small, to understand, to grow, to strengthen. That's why being dedicated and committed is vitally important. But always, every day, get into the habit of showing your kindness, your integrity, and your gratitude. Without showing those things on the outside, when it comes to financial markets, you will be punished. It's very important to show kindness externally as well as internally. When you get a loss, don't beat yourself up about it. It's normal. By being kind, you can either win or learn, and never blame. Blaming is the major problem when it comes to learning. People do not have learning difficulties that I've experienced. I used to lecture first and second year statistics for many, many years. They have blaming problems. They blame themselves for not being able to learn. And that's not what you want to do. You want to be kind to yourself. When you're learning, you just simply don't know. As a community, I always suggest go slow to go fast. I spent many years as a senior management consultant for multi-billion-dollar corporations running big teams. I always said to my staff, please go slow to go fast. Get it done right the first time. Don't rework. And that's very important to do because my work was always focused on financial analysis. You don't want errors that multiply inside the numbers. Please let me know in the comments, have you found the go slow to go fast approach to be beneficial to yourself? You can learn all about the CTKS method and gain this incredible X-ray vision inside financial markets for yourself. This will enable you to mark up your own charts and to see where the very, very heavy resistance or support is inside your charts that you're trading. Always remember, look at the Tier 1 and Tier 2 charts, especially Tier 1. If you don't understand the Tier 1 charts, the market will desynchronize you. You're only paid inside the financial markets for synchronization. Everything that you do to raise your synchronization is already good. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.